But I think the key message in all of this is make sure that you're making a rational decision around what you're doing with that extra money that's coming in, rather than it just comes into the household and who knows where it goes. I mean,
welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back again and we're on for another podcast in cold Melbourne.
Andrew, yes we are, and we're recording this just before the end of financial year. So by the time this gets broadcast, it would have just ticked over. So we're talking to everybody about the stage 3 tax cuts and some of the things that we should be doing with that money, or some of the things that we should be considering to do with that money.
Yeah, absolutely. Absolutely. So in essence, everyone is on the cusp of getting a pay rise in a couple of days. So congratulations to everyone.
Thank you to the government.
Yeah, exactly right. I mean, let's take it back a short step and talk about sort of what are the stage 3 tax cuts? What does it mean? How did it come about? And give you a chance to just a little rant, a little bit of a rant around the stage 3 tax cuts. Let's go through a quick history lesson here, Bill.
This is fantastic because this was not scripted at all. But essentially, these were the tax cuts. So it was a change and a tweak to our taxation system that came into effect by the previous government, and the current government of the day are riding on the coattails of the work that the previous government did to push it through, to claim it as their sort of own idea. They have watered them down. I might just point that out. But essentially, this was something that was legislated quite some time ago, and it's just, by the time it's ticking over, it's for this financial year coming, or by the time this episode goes to air, it would have been this financial year that we're in right now. So basically, they're tweaking or reforming the tax brackets, making a few tweaks. Essentially, what it means is, depending on how much money you earn, you will be receiving a tax cut, so more money in your pay packet each week, fortnight, month, but just depending on how much you earn, depends and dictates how much of a tax saving you will get per annum.
Yeah, absolutely. That is way less of a rant than what I expected. So last time we went on to this topic, Billy was ranting for a solid, what do you reckon, 45 minutes around the changes that ultimately happened. So I'll let everyone go back to that episode. We're not gonna kick him off again. Don't have time for that.
Andrew, it's a Friday that we're recording this, and Friday's always a good day, so I'm in a good mood, right?
Well, what was the excuse last time around? We always record on a Friday.
Maybe it was a Monday, I'm not sure.
So, long story short, there's some tax relief that's ultimately flowing down into households, and what in essence that means, we're just going to use a rough number here just to give some illustrations around what it actually means for a lot of people in terms of the amount of money that they'll be saving. So if you're earning, say, $100,000 a year, so we're assuming a salary of $100,000 a year, the amount that you'll see net, so in your bank account, in essence, at the end of every fortnight, is an extra approximately $182. Now, this will obviously vary, so it will depend on whether you've got, Hexted. It will depend on whether you've got the higher or lower income, and so we're just using some rough rules of thumb here. But $180 a fortnight into a household's income, it's a significant amount of money, right? What do we do with it?
Yeah. I think there's a couple of things. What do we do with it, and what don't we do with it?
Yeah.
So we're going to talk about some illustrations about what do we do with it and some numbers, and how, a small shift in our thinking around what we do can have some really great outcomes. But before we get to that, I think one of the things that's really important is just to talk about lifestyle creep. So lifestyle creep is something that tends
to be fair, this is probably what will happen, unfortunately, to 97.5%. That's my that's my guesstimation as to what will likely happen to the vast majority of people that get this increase.
Or it could be that these tax cuts are coming at a time when families and household need it. So they won't necessarily use it to improve their lifestyle, which is what lifestyle creep is. So when your income increases, you're doing something to increase your lifestyle. And usually as a consequence, what happens is you're increasing your expenses alongside with it. So you haven't really felt the benefit of the monetary reward, because that's translating, you felt the benefit, but in a lifestyle perspective, but it's not like you're grabbing that money and doing something with it to grow your wealth, which is what we're going to cover later. But I'm not so sure, just in the environment that we're in, obviously things are more expensive, household budgets are under pressure, interest rates are higher than what we've seen for quite some time. So whether or not people are going to use that money because they need to versus they're going to spend it on, their lifestyle, who knows? But look, interestingly enough, but what we wanted to focus on really, I think the first one, Andrew, is probably on the mortgage that we'll talk about, because that's, I guess, some really easy, low-hanging fruit. So let's go through some numbers around what that looks like.
Yeah, absolutely. So we're assuming in this scenario that there's a $500,000 mortgage. You've just taken out your mortgage, so we're looking at a 30-year loan term, and assuming an interest rate of 6.25%, so 6.25% in terms of your interest rate. Now, if you're just doing your standard principal and interest repayments, you're going to pay off that mortgage in 30 years. Fairly long time frame, but it is what it is, unfortunately. Let's say that you don't change your lifestyle at all, so everything else stays exactly as is. You don't make any changes to anything other than taking that $182 a fortnight out, $182 a month out, and using that $182 into your mortgage.
Yep.
If you put that extra $182 that you're getting from stage 3 tax cuts into your mortgage, you're saving 4 years and 3 months.
Mm-hmm.
So you're not taking 30 years to pay off your mortgage, you're taking 25 years and 9 months. That's, in my mind,
itself is huge.
It's massive.
Yeah.
You're talking about saving, 4 years off a 30-year mortgage, and all you're doing is just not spending the extra money that's ultimately coming to you.
100%.
And assuming that you don't get any pay increases to be able to do more above and beyond that. So that in itself, I think, is, it's a massive one.
Yeah. Not only is the time significant, but when you think about the amount of interest that you're going to save as well too. So what that equates to is $102,000 that you're going to save in interest paid over the life of the loan. So that's massive. And if we really want to get excited with the numbers, we've just assumed, say, one person's tax relief is going towards the mortgage. If we double this and have a look at what this looks like, and then say, okay, let's assume same scenario. So the tax relief that the household is getting is doubled, and we put that money into the mortgage. So what this looks like is $364 extra going into the mortgage each and every month. What that relates to is a 7-year and 4-month savings, and from an interest perspective, it's $172,000.
Massive.
It's huge. And, I think the key thing to point out here is there's really an opportunity to get this sorted out and structured like this right at the time that it arrives, as opposed to, getting used to it. A few pay packets have come in, and then all of a sudden it's like, there's an extra $364 in the household budget. It's going to be hard to push that across because we've already gotten used to seeing that. If you can get onto this early, do a little bit of planning, reach out to your advisor, and then set this up before it actually you see the benefit of it in your bank account. Set it up like it has not happened. These are some of the numbers that you could be looking at, and it can make a substantial difference to your wealth creation, and also from the amount of time that it's going to take you to pay off your mortgage.
Absolutely. Now, you might not run this to completion. You might, bring your mortgage down, take equity out, use that to buy an investment property. And so you do things like that, and the scenario becomes even more dramatic because you're adding wealth into the situation, you're adding leverage into it. And so that small difference is having a very big difference at the end. And that very big difference at the end can be even larger when it opens up the door for, any number of strategies that you can also do when you've got equity in your property, things like debt recycling, things like, any other strategies that you can start to deploy that otherwise wouldn't have been available. But I think the key message in all of this is make sure that you're making a rational decision around what you're doing with that extra money that's coming in, rather than it just comes into the household and who knows where it goes. I mean, it's easy to, get an extra lunch and spend a little bit more on going out, and all of a sudden, that $180 a month is dissipated. But make a rational decision. And maybe that rational decision is, hey, we've never had a holiday fund that, we put money aside and go on a holiday because, we've been feeling the pinch from a cash flow and an inflation side of things. If that's your strategy and that's what you want to do, physically put it into a separate account and save for it and put that money towards something that is actually going to have a felt difference, rather than just letting it go and not really knowing where it's ultimately gone.
Yeah.
The next one, Bills.
Yeah, one of the other things that I wanted to point out is okay, maybe not necessarily the mortgage. Let's look at this on a different tact. How about we consider, so the same scenario where you've got someone earning $100,000, the tax saving each and every month is $182. So let's just assume your, time frame to superannuation to retirement is 30 years. So maybe you're a 35-year-old and you've got, 30 years before age 65. Let's run that same scenario that we were talking about with your extra repayments into your mortgage versus let's put it into super. And if we put that number in, what is it that we can expect in terms of a amount of money coming into your superannuation account? The numbers get fairly significant, fairly substantial when we start to look at this and what this looks like. So we've just used a compounding calculator here, basically said 30-year time frame, $182 are going in each and every month. We've assumed a 7% rate of return. And essentially what that does is that's given us a result of $222,000. Let me just pause there for dramatic effects. At $222,000, if that's your strategy, and if you can get into a position where you basically ignore this money, pretend that it didn't exist, and then just divert that across.
Yeah. And superannuation is a really easy one to ignore that it exists, because you can do this from the employer level. So let's say that you're wanting to, put an extra $182 a month into super. You don't need to get paid that money and then put that money into superannuation. What you can do is just salary sacrifice, and that happens automatically. And so from the 29th of June until the 1st of July, your net pay still stays the same. So you don't actually see any difference in your bank account. You don't actually have any felt difference. And the difference that it makes is $222,000 over the course of 30 years into your superannuation fund. It's massive.
It's massive. I've got one more though, Andrew.
There's always one more.
I feel like the steak knives, but wait, there's more, right? So let's run a similar scenario. So everything stays the same, but we'll apply it in a different area. So let's just assume that you've just had a newborn and you and your partner are there, and great, fantastic, we're getting a little bit of extra money in. If you've got some foresight to think about, okay, down the track for our newborn, it's going to be difficult because it is now, so we can only assume it's going to get more difficult, that down the track it's going to be hard to get into the property market because the barriers to entry are so high. So let's just assume, for the sake of the exercise, you've got a child and you're thinking, okay, by the time they're 25, the bank of mum and dad are going to love to be able to give them some money towards a deposit. So you think, okay, maybe mid-20s is a really good age because they're a little bit more mature. They're in a position, hopefully, that they're stable in their career. They can borrow some money, and we need a bit of time in order to allow this thing to grow. But let's run that same scenario where you've got your stage 3 tax cuts of $182 per month. Same thing, you invest it for 25 years, so from their birth to age 25, you get a rate of return of 7%. You're looking at just shy of $150,000. So here you go, happy birthday, 25th birthday, we're going out to buy a house, here's a deposit for $150,000. Now, obviously this hasn't factored in inflation or anything like that. It's a fairly straightforward calculation, but the power of being able to have some discipline around what you do with this money and divert it somewhere else with a little bit of planning, with a little bit of thinking, can be extremely powerful and life-changing for whoever's involved.
Yeah, absolutely. Absolutely. I mean, I'd certainly love to have $150,000 as a deposit from mum and dad when you were finishing uni or just starting a job and getting some help into the property market. So I think the key message in all of this is making sure that you're actually putting the money to use and that you're putting together a structured plan. I mean, we could have done probably 15 different scenarios around what you do with this, whether it's using the money to save up for private school fees, whether it's putting the money aside to buy the new car that you have been putting off for a long period of time. But the key message in all of this is there's an extra $182 per month that's going to be available for a lot of people. Now, maybe yours is a little bit less, maybe it's a little bit more. But $182 a month is pretty easy to creep out of your back pocket.
100%.
If it just, gets sloshed into all of the other funds, it's really easy for that to, get washed in some other area and not really feel like there's a huge amount of difference. I mean, how many times do you get a pay rise of $5 or $10,000 a year, and at the end of it, you kind of don't really feel it. So making sure that you're putting together a plan, getting together with your advisor and saying, hey, what am I doing with this? Am I, putting this extra money towards super? Am I putting this extra money towards a mortgage? Is it going to go into offset and provide more opportunity at a later stage in time? Putting together a plan around, there's a little bit of extra money. What do? Let's make some rational decisions and let's get it working for us, because compound interest is the 8th wonder of the world. And so...
Sure, there's a Warren Buffett quote in here somewhere.
And so really taking advantage of compound interest makes a huge amount of difference, even with relatively smaller numbers in comparison to what it would normally take to achieve something, or what people normally think it would take to achieve something massive from a finance and a wealth creation side of things. Yeah,
a little bit of discipline, a little bit of foresight, a little bit of planning.
And a massive difference.
It can make a huge difference. So I'm just going to run the counter argument for a sec, that if we don't do something like that with it, and we do spend it, we could increase inflation. Big call.
Yeah. Look, it's a little bit of a deviation in terms of, what we're looking at is individual level, and then inflation is obviously a macroeconomic level, but there's definitely some concern from economists and financial advisors that, hey, while this is coming in and giving some relief to households and fully supportive of that, on the flip side, we're trying to bring inflation under control in order to be able to solve all of the other macroeconomical issues that are happening in the economy. And putting more money into households generally leads to a higher level of inflation.
So don't spend the money, essentially, in the economy.
So what Billy's saying is, don't spend the money in the economy. Do your, national duty to bring down inflation.
I feel like
and you're not only helping yourself, but you're also helping the broader economy.
I feel like a politician. What is it? One for mum, one for dad, one for the country. When they were encouraging people to have kids. But absolutely. If we are spending it and we are doing it en masse and doing it to improve our lifestyle, and using it like discretionary income, then the chances of inflation, going the other way, is quite real. So that will pose a challenge for the government, the Reserve Bank. Yeah, we'll see what happens. But I think we've done this one justice, Andrew, giving our viewers and our listeners a whole heap of information. I think it's quite timely as well too. So if it's something that you've been thinking about and you want a little bit of extra information, feel free to reach out to Andrew or myself. We'd be more than happy to have a chat.
Yeah, absolutely. Bills, thanks again for another podcast, and we look forward to catching everyone on the next one. Got some value out of that? Like, subscribe, reach out, and we'll speak soon.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.